Wall Street's week looks like it's going to end as turbulently as it began. All three major indexes closed lower after choppy trading yesterday. Major retailers are signaling concern over more inflation, warning that rising costs are going to keep hurting their profits. Meanwhile, gas prices hit another record high for the 10th day in a row yesterday. This is not getting any better with the war going on. The national average for a gallon of regular is now $4.59. Let's bring in former Treasury official and Morning Joe economic analyst Steve Rattner. Also with us, the co-founder of Axios, Mike Allen. Steve, so there are a lot of people who made a ton of money off of the stock market during COVID. We told those stories for a year and a half. But it seems now that a lot of those gains are being given back. The stock market off to the worst start since 1940. What are some of the headwinds that it's facing?
Joe, it's facing probably at least three different headwinds. Inflation, as you pointed out, is affecting the economy, but inflation is also forcing the Fed to raise interest rates, and higher interest rates are the enemy of the stock market. It's also facing a wobbly consumer who has started to feel the effects of inflation as well in terms of how much they spend. And lastly, as you pointed out, the stock market has had an amazing run, and that creates a headwind kind of in and of itself. And I can show you a bit of how all those look if you'd like.
Yeah, I'd love it.
So what you can see here is the red line is interest rates, and you can see that as interest rates have been declining since well before the pandemic, stocks were going up. And that's not a coincidence. It's not a day-to-day exact relationship, but directionally that's what happens. And then you can see the vertical black line on the right. That's when the stock market peaked, which coincidentally happened to be January 3rd of this year. And then you can see that 18% decline, as you say, the worst since 1940. And you can also see the red line, which is interest rates, suddenly shooting up. And so those two are not unrelated. Interest rates, as I said, are the enemy of the stock market. But to the other point, you can see that the horizontal black line simply takes us back to where we were a year ago, basically. In a sense, the stock market has given up its gains from a year ago, and that's where we sit at the moment.
Well, let's talk about the specific stocks. I mean, this isn't across the entire stock market equally. I remember last year during the pandemic, I talked to somebody who invested in the stock market all the time. And I said, what are you doing? They said, I'm buying the monopolies. I'm buying the tech monopolies. They're going to just keep going up. Well, they did keep going up until they started going down. Now, Steve, isn't it? It's a lot of these tech stocks. It's a lot of the stocks that did so well during the pandemic that are now getting hit the hardest.
Yeah, Joe, that's exactly right. And you can break the tech stocks down into a couple different buckets, as I can show you here on this next chart. In the upper left, you have some stocks that had benefited enormously from the pandemic. Things, as you would imagine, like Wayfair, the home furnishing company, when people were buying furniture for their home, like Netflix, which has a series of issues, but where people were increasingly streaming. And then, of course, Zoom, which barely existed before the pandemic. It zoomed up, no pun intended, and now you can see that it's come down. And these stocks have come down anywhere from 50 to 75%. And then in the next group on the right, you can see some tech stocks a bit less related to the pandemic, but also that were high flyers and have had their wings clipped, so to speak, including companies like PayPal down 58%, Uber down 47%, and so forth. And then in the lower left, the most recent group that has come under a lot of pressure, and you talked about this a bit yesterday with Brian Sullivan, are the retailers. Consumers are feeling the effects of inflation, and it's starting to show up in how much stuff they're actually buying these days and the extent to which they're kind of pulling in their horns. And so you can see even Amazon down very substantially this year because of a soft first quarter earnings report, because of soft sales. Target, Best Buy, Walmart, all those kind of companies. But who are the winners? There are winners out there. And I guess not surprisingly, they are the energy companies. And the big energy companies are up anywhere from 50 to 80%, again, because of rising energy prices.
Yeah. Okay. So, Steve, let's finally talk about whether it's time to jump back into the market or not. Of course, you give no advice, but we've seen, again, during the pandemic, a lot of people have jumped into the market for the first time, these sort of civilian day traders. have jumped in when it goes down, trying to buy it low, going up. You're saying, based on everything that you're hearing from the street, stocks may still be expensive. Yes, they've dropped, but they're still at historic highs.
Yeah, so this chart, Joe, measures stocks against their earnings. So it gives you a sense of how expensive or how inexpensive they are. And as you can see, it has been a pretty accurate indicator of some significant market turns. Black Tuesday, 1929 stock market crash. You see how expensive they were then. You can see in the late 60s when the stock market kind of rolled over for a fairly long period of time. I'm showing a market top there. You can see what happened in the early 80s when stocks really began their climb back. You can see the dot-com bubble. And then the next dip down, which I didn't mark, you can see is actually 2009 when stocks also took a turn way back up. And so you can see on the right that we were, before this downturn, at the second most expensive stock market in over 100 years. And this decline that we've had only brings us a little way down. As you say, I'm not predicting stock markets. I'm not in that business. No good investor really tries to predict stock markets. But stocks still look awfully expensive from this measure and from a lot of other perspectives as well.
So, Steve, before you go, just looking down the road, it's hard to prognosticate with this economy because there's so many conflicting factors across the globe. But we've got housing demand, we've got gas prices, we've got major companies reporting very poor earnings yesterday, the stock market, the incoming potential food crisis. What's the potential in your mind that rates will have to be raised to like 7 or 8% to sort of put the brakes on the economy and impose a recession?
Economists obviously are divided about this. It's a very unusual period. We've not really come out of a pandemic. We've not had as much excess savings as we still do have on consumer balance sheets at a time when we've also had this much inflation. The bounce you see in the stocks for today is because China actually had a good night last night. They're finally, I think, getting their act together. The question is whether we have our act together. Inflation, as I said, is taking a toll on consumers. Mortgage rates are well over 5%. Gasoline prices you just reported on at a recent record high. And so I am on the more pessimistic end of the spectrum in terms of how I think the economy is going to perform. I think inflation is going to force the Fed to raise interest rates, certainly to 5-6%, maybe higher, Mika, as you suggested, in order to get inflation back to 2%. That is a trick the Fed has never accomplished without there being a recession. And as you said, you're starting to see consumers pull back. You're starting to see somewhat weaker earnings. I'm not predicting the end of the world or an immediate recession, but the road ahead does not look great.